In the past month of trading, I've made right around $40,000 in profit, and honestly, none of it would have been possible without my simple, repeatable trading strategy. If you have a pretty good understanding of how the market moves, but you still aren't getting the results you want from trading, your problem isn't psychology. I'm telling you, once you get your typical setups and just look for them each week, trading becomes a lot easier, and it's gonna become your new normal to end every single week in profits. So in today's video, we're gonna talk about the 5 main steps to finding a trade that fits my ride the wave strategy. Starting off with time frame alignment. So the first thing we're gonna do is to find multiple time frames that show us basically the same direction. And the way that I like to do this is by actually writing down what each single time frame is showing me. So I'll start off here on the daily time frame. I'll put it's a bearish daily time frame. Then I'll go down into the 4-hour and I'll basically establish the trend. Okay, where is this market going? We see that we have these highs up here. We're making lows and we're continuously making lower lows and lower highs in the market. And that basically just tells me that this is a bearish market, even on the 4-hour time frame as well. And what I'm gonna do is just go down and just do this on every single time frame. As I do this, I'm looking for what makes the most sense for the market to continue doing, because if we're bearish on multiple time frames, it's likely that it's gonna continue to go down. So I'll just write down here 2-hour time frame as well. I'll then go down into the 1-hour time frame. I still see the same type of highs and lows being formed by the market. And then as I go down into the 15-minute time frame, I'm gonna write down that it was actually consolidating, because when I entered this trade, it wasn't trending downwards, the 15-minute. It was just bouncing from support and resistance. So I'm just gonna write down 15-minute was ranging. So once you have your time frames aligned, you're gonna go on to the second step, which is to find a trending market. In order to find a market that is trending, you want to essentially look at, okay, are we ranging or are we breaking lows and breaking highs? It needs to be consistently making higher lows and higher highs, and vice versa for sells. So right here, the first thing I see on the daily time frame, a big rejection to the top side and then massive bearish candles to the downside. It means that once we broke below this area of support, that made this a trending market. If price stays between 2.27 and 2.24500, then it's simply just ranging inside, and that's when you want to avoid taking a trade. But when the market breaks outside of that range, you can consider it to be a trending market. So for my ride the wave strategy, one of the most important factors is that the market is trending. The worst mistake that you can make is honestly entering in a trade when the market is simply bouncing off of support and resistance, because off of there, you're never going to catch the high risk to reward trades, and you're never going to be able to truly ride the wave of the market, which is how we get these high win rates and high risk to rewards. Something additional that you can use to identify the trend of the market is going to be the moving average. So the 50 moving average gives us an idea of how strong the trend is. So for example, if we're here ranging, this is on the 4-hour chart, and I see that the moving average is simply a straight line, that's not a strong trend. I want to see the moving average slanted upwards or downwards significantly. I want to see the moving average like this. And that ties us in perfectly to step number 3, getting a bounce off of an exponential moving average. So we're going to be using the 50 EMA. And as you see right now, we're on the 30-minute time frame. Price has bounced off of this EMA multiple times. Every single time it bounces off, it acts as an area of resistance. A very simple rule that you can implement is to only trade in the direction of the EMA. So if the EMA is pointed downwards, you can only take sells. Now, off of the bounce of the EMA, one thing that's important to understand is that it's not always going to bounce right off the EMA. Depending on which time frame you're looking at, it'll come close to it, but it'll still bounce off of it. You need to be flexible with where you expect the bounce to happen. It's not always going to happen right there, but what will happen is it'll bounce close to it. So to recap so far, we have time frame alignment, we have a trending market, and we're getting a bounce off of an EMA. Once you have those 3, the next step is to wait for a retest at a key level. So one of the first things I'll do is looking for round psychological levels. So if I find a price level like 2.24000, then I know that that's likely to hold as an area of support. And that's actually where I ended up taking this sell position on GBP/NZD, which I'm currently holding, and I'm up about 5.6K in profit. I waited for a bounce and a retest off of the key level. So what price did was it broke below this key level and then it retested it. Also, the moving average caught up with price. Price bounced off of the moving average, bounced off of and retested the key level, and that ties us in perfectly to step number 5, which is having an entry confirmation. Once you have that retest of the key level, you want to get some confirmation that the market's going to kind of react at your level. Because the thing that you want to avoid ever doing is just entering in off of the expectation that price is going to do something. Instead, actually wait for price to show you a reaction and then enter in, because the probability of you winning that trade is going to go up significantly if you wait for a reaction. So as you see right here, we had a bearish engulfing candlestick. As we're retesting the level, I'm watching to see if price is either going to reject off of it or if price is simply going to start trading above it. Because if price just continues to make bullish candles, I don't want to be in that sell position. So once I saw this engulfing candlestick entry, I entered in on the next candle after that, especially with this indecision candle that you see. It's kind of a doji candle plus the engulfing bearish candlestick. One of the best entry confirmations that you can use, which is not valid for this setup but will be for a lot of your trades, is going to be a big rejection wick. So let's say I wanted to enter in up here. This candlestick right here would be my entry confirmation, because when price leaves a massive rejection wick, it's most likely going to start going in the opposite direction. And when you combine all of those things, you get a very, very powerful strategy. So go test out this strategy and let me know in the comments below how it went for you. I'm telling you, if you apply every single one of these steps, your trading is going to become a whole lot better. And let me know in the comments what you want to see next, and I'll see you in the next video.